It's not just that housing has become very expensive in the US, but also how rapidly it got to this point. In the last 2 years, home prices have increased by 37%. For context, this is higher than the 2-year 29% growth leading into the housing market crash of 2008. If you live in the US, you've probably noticed the housing market boom over the last 2 years and the fact that there is a shortage of housing supply. But why is there a shortage of houses in the US? Is the rental market going through a similar boom? And is the US housing market actually going through a valuation bubble? We're going to dive deep into all of these questions, so stay tuned to find out. Stepping right into it, one of the key reasons for this is the shortage of two vital supply-side inputs for any industry: labor and raw materials. In fact, the shortages have worsened to a point where 90% of builders have reported delays and shortages of material over the last year. According to the Bureau of Labor Statistics, the prices of goods used in residential construction have risen more than 19% since last year, and overall by almost 36% since the start of the pandemic. The raw material prices have gone up by the same proportion as housing prices. This means that even when building materials have become available, the increase in the prices have been steep enough to create issues for builders. Labor shortages have aggravated the delays, as thousands of construction workers were laid off during the pandemic or switched to other industries on their own. The construction industry has been reeling from the need to replace amidst increased housing demand. Although the construction industry's employment has surpassed 2020 levels, the industry is still suffering an acute shortage of manpower needed to complete projects on time. And according to some estimations, the industry would need to hire 650,000 more workers by the end of the year to make up for the shortage. Moreover, the onset of pandemic has also prompted the belated wave of first-time millennial home buyers into the market. This wave is met by a historically low supply of houses in the market due to the pandemic-related anomalies. However, even before the pandemic, the U.S. real estate market has remained subdued for the most part in the last decade as it reeled from the 2008 crash. But what does it mean for millennials looking to buy their first homes? Well, nothing good. In fact, the generation couldn't have chosen a worse time to go into the housing market. Before we continue, I would like to invite you to join our YouTube community by subscribing to our channel and pressing the bell icon to stay connected. Our channel is based around business and economics, and our videos are about deep diving into interesting topics like this one. Historically, the growth trends in home purchase and rental market move in tandem with each other. This is because the demand for both markets is closely related, and spikes in demand in either tend to have a spillover effect. However, the growth in the rental market was initially slow to follow home buying demand after the pandemic and lockdown set in. This was because the increased demand for home ownership came from single families that wanted to move to suburbs, since lockdowns and consequently flexible work-from-home modes of working allowed them to do so. This trend depressed rents in metropolitan cities like New York and San Francisco by more than 20%. This trend has reversed over the course of last year, however, and the growth in the rental market has even exceeded the increase in prices of houses. The increase in property rentals nationwide has been mostly due to the spillover effect from increased demand for housing combined with a historically low supply. The median rent for listed apartments has surpassed its pre-pandemic peak and exceeded USD 2,000 for the first time in history. Moreover, the growth in rentals is expected to rise more steeply in the next 2 quarters as the Federal Reserve continues to increase interest rates to cool down demand and counter inflation. 30-year mortgage rates are now near 6%, which is likely to cool off demand for home ownership in the short term. But as more people postpone their plans to buy homes, the rental market is expected to climb even higher from current levels. However, these increases over the past 12 months have not been standardized nationwide, as big cities, which initially saw a decline in rentals during the onset of pandemic-related lockdowns, has seen the steepest rises. Have you seen rentals or house prices go up in your district or state in the past year? Let us know what the housing market is like in your area in the comments below. Basic economic theory indicates that home price growth and income growth must move in tandem. This is because people usually make a decision to buy new homes when they see an enhanced affordability or an increase in nominal incomes. However, this has not been the case over the last year, as home prices have grown by more than 4 times against average income growth. This discrepancy is the reason some people might have contemplated a housing crash in the offing. However, if you're looking to buy a house, you perhaps shouldn't wait for it. Although the housing market has been hitting levels not seen since the 2008 housing market crash, there's one thing missing from the equation: speculation. The current boom in the housing market can be attributed to supply-side shortages of labor and material, but also to demand-side elevated wage growth and the belated demographic trend of first-time millennial home buying. In 2008, the housing bubble was created by unwarranted structuring of financial products which allowed for unchecked accessibility to mortgages. This created artificial demand in the market, as lack of rigorous background checks allowed for mortgages with little to no down payments and nominal front-loaded schedule of payments. Unlike 2008, however, the recent increase in house prices have resulted from real transformations in market dynamics rather than speculation and unchecked financing of subprime mortgages. This is why most real estate firms forecast a continued growth in home prices for the next year. But that doesn't imply that home ownership is not getting more expensive, even on a relative scale. Latest research shows that American households are now spending almost 31% of their monthly income on mortgage payments. This percentage averaged 19.9% in the last decade. And with the Federal Reserve indicating more interest rate hikes intended to have a demand tapering impact, this percentage is expected to increase. And although a crash is a far-fetched outcome at this point, the Federal Reserve Chairman has not ruled out a decline in housing prices. A year-on-year decline in home prices is a rare occurrence outside of market crashes. But as mortgage rates rise steeply over the next 2 quarters, cooling down demand might cause a decline in prices, at least across some regions, which have seen an abnormal growth in house prices over the course of the last 24 months. Home buyers in the U.S. seem to be caught between a rock and a hard place. First-time buyers are the most intensely hit, as they don't already have real estate assets that are increasing in value to compensate for the rising costs of down payments and mortgages. What do you think? Do you think there's any real chance of a housing market crash anytime soon? Or do you think that the house prices will continue their upward spiral? What's the housing market like in your state or country? Let us know in the comments. And don't forget to subscribe to our channel and hit the bell icon to stay connected.